Good evening, friends. My compliments to the team for creating a wonderful refresher course on Ind AS. I think you have already covered 1, 8, 10, 12, 37 various Ind AS. And today we have a fantastic topic of business combination. And we have very renowned speaker, Anand. He is here to talk about this topic. Apart from formally introducing Anand, let me also make an appeal. Being Vikasa chairman this year at the WIRC, there have been good programs hosted by Vikasa. Vikasa is a student body, and we do a lot of program for the student. And kindly encourage the articles in your firm, the industrial training in your companies, to join those programs of Vikasa, so that the students moment their technical knowledge is upgraded, eventually it is going to help us, we all members. So my appeal to all of you to uh, send your student, motivate them to join the Vikasa program. Also, I'll request faculties like Anand to spare their valuable time sometime for the students. And I'll request him as and when you have your schedules at little ease, you can tell us. We'll organize some such program for the student across the western region. Formally introducing Anand. Anand is actually Dr. C.A. Anand Banka. He's a fellow chartered accountant with PhD in finance. To his credit, he has written 6 bestseller books, and he is a celebrated faculty for various courses, including International Financial Reporting Standards, IFRS. He has started very young, and he has a very good experience with various firms, as well as international firms, as well as with the industry. He started teaching and became guest lecturer and speaker at various professional forums in India and abroad, like US, UAE, and other countries, to spread knowledge about IFRS amongst the student and chartered accountant. He has started writing the books in a lucid language and about IFRS. He has been one of the youngest special invitee to the accounting standard board of the ICAI. To the credit of Anand, he has been, he has drafted the India's, he was into the drafting team also of the Ind AS, which is equivalent to the IFRS for India. At the young age, he has been partner of a top chartered accountancy firm, one of the youngest director of a global accounting firm heading at Pune, Ahmedabad office, and accounting advisory practices. He is now heading the technical accounting desk and reporting for Vedanta Group, a SEC listed company, an Indian biggest big company, diversified into metal mining group and headquarters at London. He has recently been, Anand, to his credit, again, he has been recently awarded as a Young Achievers Award 2020 by the prestigious Indian Achievers Forum. Anand, heartiest congratulations to you. And I request all of you to, welcome the Anand with a formal virtual round of applause. Anand, the floor is yours. I'm sure next, 1 hour, 1.5 hours are going to be very interesting for all of us, and it will be really knowledge gaining. So over to you, Anand.
I'll start. Is my screen visible?
Yes.
Acha, okay, I'll just share. Okay, so thank you so much for the kind introduction. And today's topic is also pretty interesting. Ind AS 103 business combinations. With all the acquisitions and all the startups, they are also acquiring each other, or companies acquiring startups. So the overall growth which is happening through this inorganic manner of acquisitions and combinations and mergers, this standard becomes all the more critical in this age and time. Also, the standard is very different from the Indian standards, the accounting standards which we have, like As14 amalgamations. So this standard is different in terms of how it perceives as what is business combination, how do you account for business combinations, then what is common control business combinations, and how do you account for them. So the standard is different from that perspective, and the thought process that it brings out is also a very different perspective of looking at things, and hence I find this standard very interesting. So we'll have a good discussion next couple of hours on this topic. So let's start with the name of the standard, which is business combinations. Now the name is structured in a way where you read combinations of business, right? So there has to be multiple businesses coming together. Okay, effectively it's like you are acquiring a business is a business combination, and hence important to
Anand, your
understand
voice
what
is
is a
breaking.
business. When we talk about AS14, okay, that AS14 is in context of, yes. Oh, I'll try switching off shortage in India. There has been a lot of fluctuations happening in north, so power shortages and power cuts. So I'll switch off my video. Is it better now?
Yes, yes, it is much better.
Is my voice better now?
Yeah. Anand, it's much
Thank you.
better.
ठीक है. So I'll switch off and I'll speak. हाँ. Yes. So I was saying uh, it this the name of the standard business combination, it is acquisition of business. Okay, combination of business effectively means acquisition of business. So what is a business becomes the most critical term to understand, because only if you understand what is a business, you will understand how do you account for acquisition of a business. Okay, now when we talk about AS14 and we compare with AS14 amalgamation as a standard, okay, it always sees amalgamation or acquisition of a legal entity. So another legal entity has to come and merge with you. Only then you apply AS14. In contrast, Ind AS 103, okay, whether a legal entity comes and merges with you, whether a part of a legal entity comes and merges with you, which has to be a business, because it has to be acquisition of business. So part of a legal entity which is business comes and merges with you, or you acquire shares of a legal entity. It need not be merger, it has to be acquisition. So you acquire shares of a legal entity which has at least one business within that entity. That is also a business combination. I'll repeat. Okay, three scenarios I said. Okay, scenario number one, a legal entity merges with you. That is there in AS14 also. It's a plain vanilla merger. Okay, option or scenario number two, a part of a legal entity which is a business is merged with your legal entity. Okay, which is like demerger of the acquiree. The entity which you're acquiring is demerged and a business comes and merges with you. Okay, that is also covered in Ind AS 103, but it is not covered by AS14. It is scoped out in AS14. The third scenario which I spoke about is you acquiring shares of a legal entity. It becomes your subsidiary, which is under AS21. Okay, so it becomes your subsidiary. That is also acquisition of a business. Okay, provided that legal entity has a business into it. Let me give a different example now. Okay, there's a legal entity which has a land bank, say five parcels of land, five huge parcels of land it has. Okay, I acquire that legal entity. Okay, normally under AS14 this is amalgamation. Okay, now under Ind AS 103, the first test that you will apply is whether that legal entity has business within it. Okay, now how do you decide whether it has business within it or not? You go and read the definition of business. So let's first go and read the definition of business, then come back and apply that definition to this example of land bank. So this is the definition of business. Okay, and this definition has been recently amended last year itself. Okay, so it says an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods and services to customers. Okay, so it has to be set of activities and assets which are so integrated, okay, that you cannot separate them. It is integrated, okay, and together they are capable of being conducted and managed for the purpose of providing goods and services to customers. So you have to test the capability of that integrated set of activities and assets, whether they are capable to provide goods and services to customers. And when it provides goods and services to customers, it generates investment income such as dividend or interest, or other income from your ordinary activities like profits on the business. Okay, so the test is capability to generate investment income or generate other income by providing goods and services to customer. That capability is the test. Generally, it consists of inputs and processes, and when the processes are applied to that inputs, okay, that that have the ability to contribute in creation of outputs. So you have to have inputs, you have to have process that can be applied to those inputs, and it has ability to create outputs. Normally there is a rebuttable presumption that a group of assets in which goodwill is present is a business. Okay, I'll explain this sentence in detail. And lastly, you have to determine this from a market perspective and not from the person who's selling or the person who's acquiring. That perspective, no, you have to look at it from the market perspective. Now let's come back to the example of land. Okay, the entity had multiple lands, multiple parcels of land. Okay, when I acquire that entity, can I say that I have acquired a business? So the question will be whether it has inputs, whether it has processes, and whether it has capability to generate outputs. Now it has no process, it is purely land. What is the input, what is the output? Does it have human resource? Does it have cash or bank? Does it have anything else which you can call as a business? Answer is no. It purely has assets. And hence what I will pay them to acquire that entity is only the value of the assets, which is land. I am not paying them for the value of the business. I am paying them for the value of land. And hence it is asset acquisition. Even though you are acquiring shares of a legal entity, or you might be merging that legal entity with your entity, irrespective of that, it's not a business combination because you're acquiring only assets. You're not acquiring a business. Okay, so if you acquire 100% shares of that entity and that entity becomes a subsidiary for you, you have to still account in your consolidated financial statements as if you have acquired assets and you have not acquired a business. What is the difference in asset acquisition and business acquisition? Why should you worry whether it's asset acquisition or business acquisition? In asset acquisition, there is no goodwill or capital reserve. Whatever you have paid is allocated to that land in proportion to their fair values. Whereas in business acquisition, you would account each asset and liability at fair value, and the difference between what you have paid and what you have received at fair value, that difference is called goodwill or capital reserve. So the accounting totally changes between whether it's a business acquisition or it's an asset acquisition. Hence it is very critical to make this distinction as to what is it that you are acquiring. Are you acquiring a business? Are you acquiring an asset? Okay, hence this is the most critical test in this entire standard. Okay, let's take another example. Say this IT department is a cost center to K&K legal company. Okay, there is another company, IT Outsourced Limited. Okay, this IT Outsourced Limited specializes in providing IT services to legal firms. Now this K&K legal company does not want to run this cost center, which is the IT company. It does not want to run the cost center. Okay, so what it does, it sells the IT department to the IT Outsourced Limited, consisting of the laptops or systems and the servers and everything that you have, IT assets, IT staff, working capital, everything it sells to IT Outsource Limited, and then IT Outsource Limited provides services to this legal firm, IT services to this legal firm. Now for IT Outsource Limited, the question is whether this is a business combination or this is an asset acquisition. So let's apply the test. What is the input here? The input is human resource, the staff, the IT assets, okay, the cash, working capital that you have. What is the process? The process is the staff will use these assets to provide services, IT services to IT department or to the K&K company, okay, the legal firm. So there is input, there is process. What is output? Capability to generate output is basically providing services. That is the output. So effectively, for K&K legal firm, this becomes a business combination. Now let's take another example. Okay, another example is, suppose there is a company which has which is into power production. Okay, now another company is a manufacturing company, say a cement company. The cement company buys out the power company and uses the assets of that power company for captive power production and consumption. Whether this is a business combination for that cement company, again apply the test. What is the input? Input is coal, input is machines, input is all the assets, the factory, the power plant, everything. That is the input. What is the process? The process that it runs to produce power, that is already there in that entire power plant, and employees and all that are there. And what is the output? Output is power that it will produce. Now whether the cement company captively consumes that power, or it sells the power, or it does whatever it wants with the power, irrespective of that, because it says, the last line says, the determination is from market participant view, and the first line, the definition says you have to check the capability of the assets and the activities integrated together. Now it is capable to generate power on its own. I can either sell the power or I can consume the power. That is dependent upon the user. But as a market participant, someone can use the power, someone can sell the power, someone can do whatever they want with the power. Effectively, the assets and the activities together as an integrated set have capability to produce power. That means it's a business, and the cement company is acquiring the business, and hence for the cement company this is business acquisition or business combination. That is how you have to test business combinations. Okay, if you have understood how to test business combinations, then half the battle is won at that stage itself. Now let's come to the point to which I had skipped earlier. There's a rebuttable presumption that a group of assets in which goodwill is present is a business. Okay. Now what does this rebuttable presumption that a group of assets in which goodwill is present is a business means? So normally when I acquire assets, what do I pay for? I pay for assets, correct? So if I acquire assets having fair value of 100 rupees, I will pay only 100 rupees. Why will I pay more? Why will I pay less? I will pay fair value of the assets, which is 100. Compare that to acquiring a business. What is different in a business? Business has set of activities and assets both, which are integrated. So that means because of that integration and activities, process, all that stuff, I'll charge extra. So instead of 100, the seller will charge 105. What is the breakup of 105? 105 breakup is 100 rupees is fair value of asset, 5 rupees is for that integration of activities, the customers, the vendors that you have, entire thing, input, process, output, all that thing you have. For that there is 5 rupees. Where do you classify this 5 rupees? You classify this 5 rupees as goodwill. Okay, so effectively for buying a business, you have paid 5 rupees extra, which is 100 rupees for fair value of assets and 5 rupees for goodwill. And hence, there is a rebuttable presumption that whenever you pay that 5 rupees extra, which is goodwill, that means you're not buying the asset, you're buying a business. I repeat, when I said, you know, uh, in a different fashion, I said you're paying 100 for assets, 5 for goodwill. So that means whenever you buy a business, you pay for goodwill. Other way around, whenever you pay for goodwill, that means you're buying a business. Okay. Now some may say that there can be capital reserve also. Fine. We are just saying that if there is a goodwill, then there is a presumption that there is a business. I am not saying that in all business there is a goodwill. Okay, you may sometimes get a good deal and you may recognize a capital reserve, or you may not recognize any goodwill because you have not paid for any goodwill in some deals. So it is deal to deal. But if you're paying for goodwill, inherently means you're buying a business. And that is what that second line says, that there's a rebuttable presumption that if you're paying for goodwill, that means you're buying an asset, buying a business. So there's a group of asset in which goodwill is present, that means it's a business. Going ahead, this is a new optional test which has been added a year back. Like I was saying, this standard was amended internationally and in India. So this new optional test has been added. Now what does this optional test say? It says that there is an optional test to identify concentration of fair values. Okay, now what does it mean? So it says that sometimes what happens, if I can give an example, is when you're buying a business, more than 90% or substantially all of the fair value, when it says, it means more than 90% effectively, more than 90% of the value that you pay for is basically concentrated in a single asset or a group of similar identifiable assets. Okay, let's take an example of power transmission assets. Now power transmission asset is a group of similar identifiable assets used for transmitting power from place A to place B. Okay, now is it a business? Yes, it's a business because there's an input, there's a process, there's output. Someone is earning by renting out this power transmission or having a contract to lease out the power transmission assets to someone who produces power, so that power can be, power can be transmitted from place A to place B. So it's a business. Now when I pay for that business, more than 90% of the value I'm paying for is a group of either a single asset or a group of similar identifiable asset. And hence, as an option, the standard allows me to recognize it as a asset acquisition rather than a business combination. So there are practical challenges when I recognize it as a business combination, because then I have to fair value the assets and recognize goodwill. And then what happens to goodwill, because life of these assets, because I'm paying for specific assets, correct? Life of these assets are limited. Effectively, I am buying a business with limited life. Okay, so then I have to amortize the goodwill, or what to do with the goodwill. So those questions arise, and hence the standard gives an option that you account for it as if you're buying assets itself, because normally business should not have a limited life, right? Similarly, other example that I can give is, of a cruise. Some companies, they have say 2 or 3 cruise. Now it's a business because you have staff, you have all the things which is there on a cruise, everything you have. But 90% of value is derived from that, 2 or 3 cruise that you have. Those are the main assets that you have. Everything else falls in the balance 10%. So there you can account for it as a business, or you can account for it as an asset acquisition. It's an option given. Okay. So it says that if there is a concentration of fair value, what is concentration of fair value? We can read the third point. It says the concentration test is met if substantially all of the fair value of the gross assets is concentrated in a single identifiable asset or a group of similar identifiable assets. Here, substantially all of fair value, like I said, generally means more than 90% of the fair value. Okay. Now, entity may make such an election separately for each transaction or event. So for every transaction or every event, you can make a different selection, which means in the first business combination, I can say I will account for it as business combination. Second one, I can say I will account for it as an asset acquisition. Third one, again, I can say that I will account for it as a business combination. So everything, every time I do a combination, business combination, I can select whether I want to apply this optional test or not. So that is up to me how to account for it if this optional test is met. If it is not met, then anyways it is mandatory to account for it as a business combination. If it is met, then our option, I have option whether to account it as business combination or account for it as a asset acquisition. And I have explained the difference between accounting for business combination and accounting for asset acquisition. Okay. When you do asset acquisition accounting, you do not recognize any goodwill or capital reserve. All of it, what you have paid, will be allocated to the assets that you have acquired in the proportion of fair value. And business combination, you fair value each asset and liability, and the difference between what you have paid and what you have received at fair value, difference will sit as goodwill or capital reserve. Going ahead. Now the business combination accounting has 5 steps. Okay, each step is very, very critical, very important. Each step is different, and hence we will have to understand each step in accounting for business combination. Okay. Like I was saying, the standard is very different from As14, and hence it is important to understand the standard. The first step is identifying acquirer and determining acquisition date. Now, why is this step important? Why do you have to, why is it critical to identify the correct acquirer? Now, correct acquirers is important because sometimes there is reverse acquisition. Okay, sometimes the acquirer is not clearly known. And what happens if the acquirer is not clearly known? If the acquirer is not clearly known, then the entire accounting is different and goes for a toss. Okay, so it is very critical to identify the acquirer. Let's take an example. Okay, say there are a lot of case studies here which I have taken. Let's take an example. So the shareholder of A and shareholder of B both hold 50-50% in C. Okay, and chairman of A is appointed as chairman of C. Now, who is controlling C? Whether it is A controlling C or B controlling C. Now, in this example, control here you will have to test by way of management control. And because chairman is appointed by A, hence the management control is lying with A. And hence here in this transaction, A is the real acquirer and B is only an investor. Okay, let's take another example. A and B go and merge into C. So A is also merging with C, B is also merging with C. A and B get dissolved and C remains and C continues. Okay. Now, because A has merged with C and B has merged with C, C has to pay something to the shareholders of A and B. Now, C is a new entity. C does not have cash. So, C pays in terms of its own shares to shareholders of A and shareholders of B. Now, when it pays in terms of cash to shareholders of A and B, shareholders of A receive 80% shares, shareholder of B receive 20% shares of C. So effectively, shareholders of A get 80% holding of C and shareholders of B get 20% shareholding of C. Now the question is, who is acquiring whom? Whether C is acquiring A and B, A is acquiring B and C, B is acquiring A and C. There can be three combinations, and every combination will give a completely different accounting answer. Okay. Now what is the answer here? Answer here is, since A is effectively getting control of C by getting 80% shares, it is effectively getting control of C. So A is getting control of C and C includes B. Correct? Because C has acquired B. So A is getting control of B and C both. Hence, acquirer is A, acquiree is B and C. I repeat, in spite of surviving entities C and A and B have dissolved. C is surviving, A and B dissolved. In spite of that, it is A which has acquired B and C. This is completely different from what we do under accounting standards. Okay, completely different under what, as compared to what you do under accounting standards. Okay, under accounting standards you would say C is the acquirer, A and B are the acquiree. Under Ind AS we would say A is the acquirer, B and C are acquirees. Okay, now how do you account for such kind of business combinations? So in the books of C, because C is the remaining entity, so you will prepare only the books of C. In the books of C, A will be at carrying value. So all the assets and liabilities of A will be carried forward at carrying value. All the assets and liabilities of B will be at fair value. Okay. C being a new entity, it will not have much of assets and liabilities. So there is no question of fair value, carrying value, but principally even assets of C will be fair valued in the books of C. Then what is the purchase consideration? Purchase consideration in this case is the share of C which is provided to B. That is the purchase consideration. Now what is the value of C? Shares of C. C is a new company, but you don't see value of C in terms of that. When you calculate the value of shares, you have to calculate as post acquisition value of shares. Post acquisition value of shares, A and B have a significant value, right? So the value of share of C is significant. So the purchase consideration is the 20% shares that C has given to B. That is the purchase consideration, which includes value of A and B. Correct? So if you see how accounting will be done, net assets of A will remain at carrying value. Equity of the group, when I say equity, it means share capital and reserves and surplus largely. Share capital will be of C because that is the legal parent. And all the reserves, which is the equity, okay, reserves and surplus, will be that of A plus fair value of B. So it's a unique accounting that is required to be done in such cases, and hence identifying who's the acquirer becomes critical. If I go back to the step 1, I was talking about identifying the acquirer. So entity that obtains control of other businesses is the acquirer. Correct? That is the basic logic. It is only that you have to identify who is acquiring control of whom. But it gets confusing there only, that who is acquiring control of whom. Okay. But whoever acquires control is the acquirer of business combination. How do you identify who is the acquirer? You apply guidance in Ind AS 110. In Ind AS 110, there is a definition of control which you need to apply. Okay. Then there are some additional factors in 103. Okay. Additional factors are, it's mentioned in the second point. 4 bullet points are there. Acquirer is usually the entity that pays cash, okay, or pays assets and incurs liability. Okay, whoever pays cash is the acquirer. Okay, acquiree never pays cash. Acquiree receives cash. Acquirer pays cash. Okay, you have to see relative voting rights of the combined entity. So if you remember A and B, A, B and C example, relative voting rights of combined entity C, 80% were with A, and hence we said A is the acquirer. And then you have to see composition of the governing body or the senior management of the combined entity. So in the example I gave, a chairman of A becomes chairman of C. That is the example where composition of governing body or senior management becomes important. Okay. And lastly, you have to see relative size of entities. Okay, but this is only an indicator. Sometimes a smaller entity acquires a larger entity. Okay, so not necessarily always the larger entity is the acquirer, but normally the larger entity is the acquirer. Is that fine? Any? I hope there are no questions. Questions we can take at the end. If there are any issues, I'll take at the end all the questions. But I hope I'm explaining this concept clearly. Okay. Lastly, it may result, like I was saying, reverse acquisition. If a smaller company acquires a larger company, it's called reverse acquisition. Okay, so it may result, such kind of transactions may also result in a reverse acquisition. So this case study we have done, this case study we have done. Okay, acquisition date. Now this is also critical. When do I recognize business combinations? Okay, hence each step I was saying is very critical. So first subpart of the first step was identifying who is the acquirer. Second subpart is about identifying the acquisition date. Now Indian context, we have seen backdated effective dates in case of amalgamations or mergers. You get you file schemes, merger schemes. Those merger schemes have appointed date. Okay, that appointed date is effectively backdated, 2 years back, 3 years ago, 4 years ago, generally at least 2 to 3 years ago. You have seen it normally is not 4 5 years ago, but at least 1 to 2 years ago is very normal in India. Okay, so when do I account for business combination? Do I go back and account 1 year ago all the business combination? So here the answer is date of acquisition is the date when acquirer obtains control of the acquiree. Whenever you acquire control of the business, now you cannot acquire control of the business backdated. Okay, only thing that can happen backdated is backdated profits belong to you. So 1 year back, whatever profit has been earned in 1 year, that belongs to you. That is possible. But you cannot go back and say 1 year back all the decisions that has been made in 1 year is null and void. You don't have that power. You are not controlling it since 1 year ago, right? You are controlling only from the effective date of the order, which is today. The appointed date may be a year ago, but you're not controlling from a year ago. So acquisition date has to be the current date, the date when you acquire control. It cannot be backdated. It cannot be the scheme filing date. It cannot be the backdated. It is the date when you actually acquire control. Now, normally in India nowadays, the scheme when you file it, it has to be along with a CA certificate which certifies that the scheme is in accordance with applicable standards. Okay, so hence you have to ensure that the scheme is as per Ind AS 103 whenever Ind AS is applicable, and hence you have to ensure that the acquisition date is correctly mentioned as the date when the order becomes effective rather than the appointed date. Okay, so for tax purposes, for all other purposes, you can do backdated thing, but for accounting it has to be prospective. It cannot be backdated, at least in case of Ind AS 103. Okay, now in Caro also and Schedule 3, I think, I'm not sure, Caro Schedule 3 for sure has this requirement now to state wherever your scheme is not in accordance with the applicable accounting standards, you need to give details in Schedule 3. Okay, and there's always a EOM generally wherever the scheme and accounting standards are different from each other. So scheme is not as per accounting standard. Generally, auditors give emphasis of matter paragraph to explain that there is a difference in accounting done as per the standards. It should have been different accounting. Okay, so there are implications if that scheme is not as per accounting standards. So coming back to Ind AS 103, acquisition date is date when you acquire control. It cannot be backdated. Now, what is the date when you acquire control? So let's take a couple of case studies here as well. Okay, so suppose A and B commence negotiations on 1st of December for A to acquire all of the shares in B. In January, the boards of A and B reach a tentative agreement that the purchase will take place if B can confirm that the land is not disputed. So basically A has doubt on the land's ownership of the title deed. Okay, so only when the title is clear on the land, then A and B are clear with the acquisition subject to title clearance on the land. On 1st of March, it is concluded that the land is not disputed, the title is clear. On 1st of April, a final agreement is signed and Y appoints a new board of directors. Now, what is the acquisition date? The 1st of December, January, March, or April? Okay, again, the principle is the date when you acquire control. Control means what? Control means power to appoint board of directors, power to vote in majority. Okay, these are indicators of your control. Okay, otherwise the control definition is given in Ind AS 110, which has 3 pillars. Okay, when you do Ind AS 110, that control definition will be discussed in detail. But effectively, Ind AS 110 defines control as you should have power, you should have ability to exercise the power. That means you understand your power and how to use the power, where to use the power. So that ability to exercise the power. And third one is you should be exposed to variability in returns. So that means if there's a loss because of your decision, then the loss is also yours. And if there's a profit because of your decision, then the profit is also yours. It should not happen that upside, that means profit is yours, but the loss is not yours. Okay, so that should not happen. You should be exposed to variability of returns in equal measure. Okay, so these are the 3 pillars of control. But effectively, in simple terms, we can say that if you have power to appoint board of directors, okay, if you have power to cast majority of votes, these are simple indicators of control. Okay, now when does A get power to appoint board of directors? That is the question you have to answer. Is it 1st of March or 1st of April? In form, it gets power to appoint board of directors on 1st of April. In substance, does it happen on 1st of March? Okay, if the answer is 1st of March, it gets power to appoint board of directors, whether it appoints or not, irrespective of that, it has power to appoint, then the answer is 1st of March. Otherwise, the answer is 1st of April. Okay. What changes? What changes is if your year end is 31st of March, whether you will account for business combination in the current year or next year. That is the biggest change that will happen between these two dates. Okay. The next case study. A and B commence negotiation on 1st of April for A to acquire all of shares in B. Okay. On 1st of August, the agreement is finalized and A immediately obtains the power to control B's operations. The agreement states that acquisition is effective 1st of April 2011 and that A is entitled to all profits or losses after 1st of April 2011. The purchase price is also determined by reference to the net assets of B, the acquiree, as at 1st of April 2011. Now, what is the acquisition date? I'll just give you a few seconds to go through this case study and try and answer this question in your minds, and then I'll put out the answer in a few seconds. Okay, so here the question clearly says that 1st of August is the date when A obtains the power to control B's operations. Okay, since A obtains power to control B's operations on 1st of August, the acquisition date is also 1st of August. Just because the agreement says that the agreement is effective 1st of April does not mean the business combination accounting will be done from 1st of April. It only means, like I was saying, that profits will be yours or belong to A from 1st of April. So the accounting of commercial sense of this agreement, which is profits and purchase consideration, all that stuff may happen with respect to April, but accounting for business combination will be applied only from 1st of August. Now, if you ask me what is the difference between accounting and commercial substance, which I was talking about right now, or effectively what happens, how do you account for the profit between April to August? So what is the difference? I will not take April to July sales, purchase, expense, all these transactions I will not include in the consolidated P&L of B. I will only include consolidated P&L of A, the acquirer. I will only include all these items from 1st of August onwards, not from April to July. Okay. Then what happens to the net profit of this period? The net profit of this period is effectively adjusted from the purchase consideration. Okay. So if I paid 100 and from April to July the profit earned is 2 rupees, then the net consideration that I paid is 98. So the entire calculation of goodwill, capital reserve, everything will happen as if 98 is the purchase consideration and not 100. So that is the difference between the commercial substance of the transaction and the actual accounting that you will do. Okay, let's go ahead. Next case study. A and B are telecom operators. A makes a bid for B's business. DOT or TRAI announced that proposed transaction is to be scrutinized from competition law perspective, whether it is violating any competition laws, given that A and B are the two dominant entities in this sector. A and B agree to the terms of acquisition purchase price, but the contracts are made subject to competition authority clearance. Now, how will you decide when is that A is acquiring B? Okay, is it acquiring immediately now, or is it will it acquire only after DOT or TRAI clear this entire competition law violation issue? Okay, when will you consider the business combination date? Again, I'll give you 10-15 seconds to think about it, and then I will give out an answer. Okay, so the answer is that the date principle first. Principle is date of acquisition is date when you obtain control. Okay, control basically means uh, appointment of, you have power to appoint the board of directors, you have to power to do voting rights and all that stuff. So question is, whether do you have that power today? Whether can you appoint board of directors today? Whether you can take decisions on behalf of that company B today? Answer today is no, because if you do that, then effectively you're violating competition laws, or you're violating the DOT TRAI order. You have not waited for that clearance. How can you take decisions today? Unless DOT or TRAI clear this proposal, you are not allowed to take decisions on the behalf of B. So answer today is you don't have control today over B. You have to wait for the scheme to get approved. Only then you can exercise the control or exercise your powers. So today you don't have ability to exercise the power, and hence the date of acquisition is not today. Date of acquisition will be a date after the scheme is cleared by the regulators. So that was our first step of business combination, which is to identify the acquirer and determine the acquisition date. The second step is identifying and measuring the consideration transferred, which is your PC, purchase consideration. Now, consideration transferred will include, say, any assets that you have transferred, okay, which is cash, or any physical asset if you have transferred. Second point is liability incurred towards previous owners. So any liability taken over, banking liabilities in case of IBC companies, that liability taken over is also in a sense consideration transferred. So consideration transferred will include assets given like cash paid or assets paid, or liabilities taken over, or equity instruments issued. So you can issue your own equity instruments to the original owners of the acquired entity. So that is also consideration transferred. So it can be assets transferred, it can be liabilities taken over, or it can be equity instruments issued. Okay. Now generally there is a interpretation under IFRS which says that liabilities incurred towards bank in case of IBC, okay, is not considered as part of PC, purchase consideration, because specifically the standard says that you have to include only liabilities incurred to previous owners. So any liabilities towards the owners is PC. Okay, liability incurred to lenders is not PC. Okay, so while in normal commercial sense, we may say that in IBC scenario, even the debts taken over of the lenders is purchase consideration, but in technical consideration, these are not considered as part of purchase consideration. Okay, so be careful about this scenario in IBC scenarios or in any other scenario. Liabilities incurred towards third parties is not part of PC. Only liabilities incurred towards the previous owners is part of PC. Okay. Now, whatever you pay or whatever you incur towards previous owner, all the equity instruments that you issue, all of them will be measured at fair value. Okay, you have to measure them at fair value on the date of acquisition. You are required to identify any items that are not part of business combination and then account for such items separately from business combination. So for example, if there are multiple agreements being signed, see, go back to the case of that legal company case study which I discussed the start. Okay, now there are two transactions which happened. The first transaction was legal company selling its IT department to the IT outsource limited. The second transaction was IT outsource limited providing IT services to the legal company. So there are two transactions. You cannot account as them as an integrated transaction as part of business combination. You need to identify items that are not part of business combination and then account for it separately. That is the principle. And one such common example is acquisition related cost. Okay, cost that you pay to uh, uh, lawyers or any other cost that you incur as part of business combination, all those costs will go to P&L immediately. Income statement, it will go to immediately. You cannot include that as part of goodwill. Okay, and last part of consideration transferred is contingent consideration. What is contingent consideration? Now, sometimes these schemes say that I will pay you 100 rupees upfront and then I will pay 10 rupees extra if you achieve a profit of X in the year 1, or 5 rupees extra if you achieve a profit of X plus 1 in year 2. You know, so kind of the consideration or a part of consideration is contingent upon future events happening or not happening of future events. Because it is contingent upon happening or non-happening of future events, okay, uh, it's called contingent consideration. Now, how do you account for such contingent consideration? You account for them at fair value at the acquisition date. What do you mean by fair value at the acquisition date? You first identify the probability of that profit being achieved. Okay, I've taken an example of profit. Other examples could be share price or something else, you know, anything which is not in the hands of either parties. Okay, uh, so it can be anything which is contingent based on future events. So what is the probability of that happening? Suppose probability of achieving profit of X in year 1 is 70%, and you will pay 5 rupees extra if that profit is achieved. So 70% of 5 is 3.5, and then you discount it by 1 year because this amount will be paid at the end of 1 year. So the discounting is say 0.5. So effectively 3 rupees is the fair value of that 5 rupees that I have to pay, which is contingent upon the company achieving profit of X after 1 year. So that 3 rupees will be accounted for as purchase consideration or as part of purchase consideration when I do the business combination accounting. Okay. If it's a financial instrument, not just I'll not pay cash. Say I will pay in form of NCDs, non-convertible debentures or bonds, or maybe equity shares in future, something like that. If I will pay, then it also becomes a financial instrument, and then it will be classified into equity or liability as per Ind AS 32 and then accounted for as per Ind AS 32. So initial accounting will be as per this standard, but later accounting, classification, measurement, everything else will be as per Ind AS 32. Subsequent accounting, as we call. Okay. Sometimes it may even be an asset. So I will pay you 100 rupees now, but if it does not achieve a profit of X after 1 year, you refund me 5 rupees back. So it can even become contingent asset. Okay. So in that case, also same consideration will apply. That means you will apply probabilities. You will see what is the probability of event happening. You will multiply it with what money you will receive back. Okay, and then discount it, and that becomes the fair value of consideration, and that you have to reduce it from 100 rupees. Okay, so your fair value of consideration will be say 97 rupees instead of 100 rupees. And then you will calculate goodwill or capital reserve basis that. So that is called contingent consideration. Let's take an example. Okay, I just want you to go through this example on the screen. Maybe I'll give you a few seconds. How do you read it? So there's entity A and entity B. The first arrow is consideration of 1 million, which will be paid to acquire the entity. Consideration of 0.5 will be extra if after 1 year profit is more than 0.2 million, and consideration will be 0.5 extra if profit after 2 years is more than 0.22 million. Okay, so how do you account for it? Just go through this example on the case study. Uh, Take say 30 seconds, and then I'll explain again. Okay, so in this example, as I was explaining, the initial payment is 1 million. Then there are two payments of 0.5 million each, which is conditional upon future earning targets. The first one is profit after 1 year, and second one is profit after 2 years. Assuming that based on probabilities and discounting and all of it, the fair value comes to 0.25 million only. So when you do the business combination accounting, the purchase consideration will be 1 million of initial payment and 0.25 million of the fair value. That means 1.25 million will be considered as purchase consideration. Now what happens if the first target is met or both the targets are met? Okay, that means you will have to pay that 0.5 million and 0.5 million after 1 year and 2 years respectively. What happens? Can I go back and change the goodwill? Where will I account for the payment? Answer is you cannot change the goodwill. You have done a fair valuation. That means your expectation, and basis that you have done goodwill accounting or business combination accounting. You cannot change that unless there is an error. Okay, if there is no error, no change. So what happens to what you have paid? Effectively, you have paid 0.5 plus 0.5, 1 million extra. Total 2 million to say. Okay, 1 plus 0.5 plus 0.5, 2 million you have paid. But you have recorded only 1.25 million. Okay, so you have paid 0.75 million extra. That 0.75 million extra that you have paid will go to income statement, will go to P&L as expense. You cannot capitalize it as goodwill. You cannot include it as part of business combination accounting. You have to keep it separate. moving on. So you've been through two steps of business combination accounting. The first one, identifying acquirer, determining acquisition date. The second one, identifying and measuring the consideration transferred. Now the third one is critical. Third one is important. Okay. Third one says identifying and measuring identifiable assets and liabilities. What does this mean? Identifying and measuring identifiable assets and liabilities. Okay. Now, what is identifiable? Something which we can touch, feel, like the laptop in front of you or the mobile that you have. Every mobile is identifiable from each other because of the IMEI number or the reference number or some other something else it will have that you can identify it from. Software, is it identifiable? For software to be identifiable, there has to be some serial number or some password or something. It has to have different or unique from the others. Then also it becomes identifiable. So, I'm sorry. You have to identify the assets and liabilities that you have acquired. How many of them are identifiable? You have to record only those which are identifiable. Now, when you do a business combination, you also acquire the brand, you acquire the customer list, you acquire the trademarks, you acquire the patents, you acquire the website, you acquire so many things. Okay, so tangible assets will definitely be identifiable, but it is the intangible asset where it requires judgment, where it requires you to exercise caution and understand what are you actually acquiring, how much you are paying for them, and whether those are identifiable and whether you can recognize them or not in the books of accounts. Hence this step becomes critical because under AS14, okay, or AS21, you would account for all those things only which are there in the books of the seller, which is the acquiree. Okay, but under Ind AS 103, you account for all assets and liabilities that are identifiable, whether the acquiree has recognized them in its books or not. The best example is brand. Okay, for example, say Patanjali. When Patanjali creates its own brand, okay, it cannot capitalize it in its own books. But if someone else acquires Patanjali, then you are paying for the Patanjali brand which it has created. You have to pay money for that. So you are paying money for acquiring Patanjali brand, and hence as an acquirer you can recognize them in your books. But Patanjali itself could not recognize the brand in its own books. That is the difference, and that is the best example. Other examples are customer list, okay, contracts which are being performed. It's not completed, so I have entered into a 5-year contract. 1 year elapsed. Okay, someone buys my company. 4 year of the contract is pending, but contract is signed, right? So the person who is buying my company gets benefit of the balance 4 years of the contract. So the person who is buying my company has to pay me for those contracts. Correct. So that is also a identifiable asset that the person gets when it buys my company. Okay, and I would have not recognized those contracts in my books. Unperformed contracts. The balance 4 years is not an asset in my books. Okay, but when the acquirer pays me for those unperformed contracts, that buyer can recognize those as intangible assets. So you need to be very careful on all those items that you recognize in the books of accounts. The idea behind this is anything that goes into goodwill under IFRS, you don't amortize it. You only keep testing it for impairment. Such goodwill has indefinite useful life. Okay, so you keep on testing it for impairment without amortizing it. Now, when you say recognize assets like customer list or unperformed contracts. All these have limited life, 3 year, 5 year, 7 year, 10 years. Okay, so you will amortize these, and hence it will not be recognized as goodwill. So as many assets that you recognize out of goodwill, okay, it is better for the acquirer's books, because those have useful life which is finite, specific useful life, which you will amortize it, and hence only bare minimum amount sits in goodwill. That is the basic principle of this standard. Okay, so identifiable assets acquired and liabilities assumed. General recognition principle is it must meet the definition of assets or liabilities at the acquisition date. At the acquisition date, anything that meets the definition of assets and liabilities you can recognize in the books of accounts. And it must definitely be part of acquisition. You can recognize, or you have to recognize, I would say mandatory to recognize even those assets which were not recognized by the acquiree. Like I was explaining, even if acquiree has not recognized those assets, as an acquirer you have to recognize all those assets. Okay, all those assets and liabilities will be measured at fair value. Contingent liability. The first pointer is actually definition of contingent liability. I'll give you say 15-20 seconds, just go through the definition of contingent liability, because in the words there are certain things which are critical, like possible obligation, present obligation. All those words are critical. Please concentrate on those words when you go through the definition of contingent liability. You might have gone through the definition multiple times, but now look at it from a different eyes. I'll explain how to read it then, because this is one critical part of business combination accounting. Okay, just go through the definition of contingent liability. I'll give you 10-15 seconds. Okay, let's discuss now. Contingent liability is one present obligation that arises from past events. Okay, so it can be present obligation which is from past event, whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events which are not wholly within the control of the entity. What is an example of this? Okay, this is a possible obligation from past event. Okay, so for example, there is an accident that happens, and there is a lawsuit which is filed against the manufacturer of that machine. Okay, now when you file a case, there is an obligation, possible obligation. If the customer wins the case, then the company has to pay the money. If the customer loses, then the company has no obligation. So there is a possibility of obligation. The company has to test the facts of the case, the legal opinion. Based on that, it will make a decision whether it is possible or it is probable. If it is possible, it will be contingent liability. If it is probable, then it will be a liability. So accordingly, the testing will be done. Okay, so this is an example. The second para or the second pointer is on present obligation. So present obligation that arises from past event but is not recognized. So even though it's a present obligation, it is not recognized because it is not probable that economic outflow will be required to settle the obligation. What does it mean? What is an example for it? Say suppose income tax demand. Income tax demand is a present obligation because you have already received the demand. Now you have to test whether there is a probability of economic outflow. If it is probable that economic outflow will happen, then it's a liability. If you say, no, I have a very strong case, I will fight this demand, I'll go to tribunal or high court or supreme court or wherever it has to be gone, and I will fight this case and win this case, then you will say that there is a present obligation, but outflow is not required to be settled. Economic outflow is not probable to settle this obligation. Because economic outflow is not probable, it's only a contingent liability and not a real liability. Okay. Now, why are we discussing contingent liability in a business combination? Now, imagine I am acquiring a company. Now, what is the fear generally which acquirer has? यार उसका कोई केस तो नहीं चल रहा है, कोई litigations तो नहीं है, पुराने cases, पुराने पाप which will come back and haunt me after its acquisition. So I am always scared about the past litigations and all. And hence contingent liability becomes critical when you acquire any business. And hence companies many a times nowadays prefer this IBC scenario, because once it has gone through IBC, okay, it is said that all past liabilities are washed off. You don't inherit any past liabilities. Okay. So anyways, here you have to go through the contingent liabilities of the acquiree and then assess whether there is a present obligation from past event in any of these contingent liabilities. That is the second part. The first part, which is possible obligation, will continue as contingent liability in the books of acquirer also. The second part, which is a present obligation, okay, but the acquiree has not recognized the liability out of it. It has only disclosed it as contingent. In that scenario, you need to fair value the present obligation from past events based on probabilities of it happening or not happening. Okay, and when it will happen, if it will happen, and then discount it. So you fair value it, you present value it, you discount it, you do all those adjustments, and then record it as a liability in case of business combination. So contingent liability of the acquiree becomes liability of the acquirer in such scenarios, but not all contingent liabilities. Again, I'm saying it is only that contingent liability which is a present obligation. Only that contingent liability you need to fair value, and that will become a liability in case of business combination. Okay, so this is about contingent liabilities. Let's go ahead. So we have done 3 steps till now. Okay, step number 1 was identifying acquirer and acquisition date. Step number 2 was identifying and measuring the consideration transferred, which is your PC. Step number 3, identifying and measuring the identifiable assets and liabilities which you have acquired. Okay. Step number 4, measuring non-controlling interest. Now this is also very different from your accounting standards. AS21 generally, which is on consolidation, because when do you have a non-controlling interest? Non-controlling interest is not there in case of mergers. Non-controlling interest only arises in case of acquisition of shares of a company which becomes your subsidiary, but you don't acquire 100% of the shares of that company. you acquire only part, say 70% or 80% or 90%, whatever, a part acquisition you do of the shares of the company. So acquisition of only part of the company, then there is a non-controlling interest. Okay. Now if you go to AS21, which is on consolidation, where if you acquire part of the company, okay, how do you measure non-controlling interest? So under AS21, what you do is you proportionate share of assets and liabilities. So whatever is the value of net assets of the acquiree, okay, that into proportion of NCI non-controlling interest. So if the NCI percentage is 30%, and if your net assets value is 100, then 30% of 100 is 30 rupees, NCI becomes 30. However, under Ind AS, there are two options available. What are the two options? Option number one, you take proportionate interest in fair value of net assets. Option number two, you fair value the NCI. How are these two options any different? Okay, let's have an Excel sheet. Okay, I'm just opening an Excel sheet. Just 1 second, it's just opening. I'll show you what is the difference between Ind AS and accounting standards here. Okay, so you can see the Excel sheet in front of you. Okay, now what we used to do under accounting standard AS21, okay, AS21 goes by carrying value. So if my assets and say equity and then liability, okay, so assets carrying value and then fair value, okay, here also carrying value and then fair value. 100, sorry, assets is 100, equity is a 60, and then there is NCI, or let's say this is balance sheet of acquiree. Liability is 40. When you total it up, okay, and suppose the fair value is 150, liability fair value remains 40, so this becomes 110. And additional information, purchase consideration is say 180. Okay, now let's see what happens under AS21. Okay, so let's put AS21 here. Under AS21, minority interest we call it. Minority interest is effectively, we say net assets, which is 100 minus 640, which is 60. Okay, and suppose you know acquirer has say 70% and MI or NCI is say 30%. So what we will do is under AS21 we say MI is net assets multiplied by, so MI is 18. Under Ind AS you have two options, okay, proportionate share and second option is fair value. Now when we do proportionate share, okay, you will take fair value net assets, so this minus this, which is 110, okay, and 110 into 7 this 30%. So here we took proportionate share of carrying values. Here we are taking proportionate share of fair values. So that is option 1. Okay. Fair value of NCI. This is option 2. And this is free option. You can select whichever option you like. Both options are allowed. Fair value option, what you will do is, let's say we have paid 180, right? 180 for 70% means what have we paid for 30%? So 180 divided by 70%, you have paid this much for 10% every percentage. So you will multiply by 30%. So answer is 77. So these are the three options. Okay. All the three answers I would say. Under AS21 I would have recognized minority interest as 18. Under Ind AS I have two options. I can recognize proportionate share, which is fair value, net fair value multiplied by 30%, or I can find out the fair value of 30%, which is if you have paid 180 for 70%, how much is the value for 30%? So the value of 30% is 77. Okay, this is a very rough way of calculating fair value. In real world, you would calculate fair value by actually giving it to some expert who will calculate the fair value, and they calculate fair value using a lot of benchmarks, that a similar company which is listed company, what is its price earning ratios, or what is it capital market cap and all that stuff. So a lot of scientific way of doing it. I have just taken a simple way to explain how does the fair value method work. Okay, in normal world you will go to an expert to calculate the fair value if you have to apply this method. This proportionate share method is pretty easy, that can be applied by anyone, but if you were to apply the fair value method, then you would probably go to an expert. Okay, let's go back to the slide. So saying under Ind AS, non-controlling interest is measured either at proportionate interest in fair value of identifiable net assets, okay, which is option 1 which I explained in the Excel, and the other method is fair value method. You can use whichever method you want, and for every business combination you can choose a different method. On transaction by transaction basis you can choose a different method. So one business combination option 1, another business combination option 2, every business combination you can choose a different option. Okay, so free choice you have. Now if someone asks what is the benefit of choosing option 1, what is the benefit of choosing option 2, okay, if I again go back to Excel and explain you, this is a simple option, right? Any company which wants to choose the simplest of options, they can choose by this, that's simply net assets multiplied by 30%. Okay, why will someone go for fair value option? Now fair value option is the real reflection of what I have paid. Okay, this is the real reflection of what is my NCI on this date. Okay, so if someone wants to reflect the real value of non-controlling interest, they may go with fair value option. If someone wants convenience, and sometimes it's not so important also as to what is the real value of NCI, because no one is actually going to ask its money back. Okay, NCI will not be going to ask its money back. It is only purely an accounting thing which is done, and hence convenience becomes important sometimes. So anyone who wants convenience and ease of method, they can simply go by proportionate share method. Anyone wants to actually reflect what is true value of NCI today, they can go by fair value method. So remember this, whatever method you choose as initial accounting, this only initial accounting. You don't have to keep doing fair value every year. Okay, every year what will happen is you will simply do allocation of profits to the parties. So 70% of the net profit will go to the owners, 30% of the net profit will go to NCI. That is the accounting that you have to do year on year. Only initially you have option either to do fair value or proportionate. Okay, irrespective of this option, year on year only simple profit allocation. And hence, even if you choose the fair value method, year on year it's only allocation of profits after that. So starting point is fair value, after that year on year keep allocating the profits. Simple. So let's go back to the slides. So let's take a case study. Okay, entity A acquires 80% of entity B for 1 lakh. Fair value of entity B net assets at the time of acquisition equals 80,000. Now I want you to open up your Excels and find out what is the goodwill as per proportionate value method, proportionate share method, and as per fair value method. Both methods, I want you to calculate what is non-controlling interest and what is goodwill. Okay, take couple of minutes, try and calculate what is, again I am saying, what is non-controlling interest and what is goodwill by both methods, proportionate share method and fair value method. I'll give you couple of minutes, then I will disclose the answer. I hope you are doing it by both the methods, proportionate and this, and I hope your answer of goodwill is different as per both the methods. It has to be. So let's start discussing the answer now. Okay, this is the proportionate method, proportionate share method or proportionate interest method. Okay, now your PC was 1 lakh. Okay, fair value of assets acquired was 80% of 80,000, which is 64,000. NCI is 20% of 80,000, which is 16,000. Very simple answer. Net assets 80, goodwill 36, consideration 1 lakh, NCI 16,000. Let's go to fair value method. Okay. Consideration 1 lakh. Fair value method, fair value of NCI. If 80% for 80% acquisition you are paying 1 lakh, then for 20% the fair value is 25,000. Correct. This is the simple method that we devised. Otherwise, like I was saying, in practical life, we'll go to some expert who will fair value basis lot of science like P ratio, price earning ratio, or some what is the valuation multiple and all that stuff. What is the list price of similar entities which is listed. So it will apply a lot of science and come up to an answer. But in our normal life, a simplest way of doing it is 1 lakh divided by 80% into 20% is 25,000. Now fair value of assets acquired is 80,000. So goodwill is 45. So the formula is PC plus NCI minus fair value of net assets acquired will give you goodwill. So if you see the journal entry, net assets debit 80,000, goodwill debit 45,000, bank because you have paid consideration, so bank credit 1 lakh and NCI credit 25,000. So if you compare the first case, here the NCI was 16 and goodwill was 36. In the second scenario, NCI is 25,000 and goodwill is 45,000. Okay, so there is a difference in NCI, and goodwill is always the balancing figure. So the difference of 16 and 25, which is 9,000, 16 is NCI as per proportionate method, 25 is NCI as per fair value method. The 9,000 differential goes and sits in goodwill, and hence as per proportionate interest method, goodwill is 36 and fair value method, goodwill is 45. Okay. Normally when you do business combination, there is an element of deferred tax also on it. Okay, so let's go back to the Excel sheet. Okay, and let's understand how does deferred tax impact me. Okay, so suppose carrying value of net assets is 100, fair value of net assets is 150, and PC was 180 in our example, right? So I'm continuing with the same values. Now, as per tax law, suppose you are allowed deduction of cost to previous owner whenever you do business combination. That means 100 will be, suppose, carrying value as per tax also. This is also as per tax. So there is no difference between tax and books in depreciation, assuming that. Also, okay. So as per books is also 100, as per tax is also 100. Now this is what is allowed in future also post acquisition. So you have paid 150, sorry, fair value. In the new console books, the account assets are recorded at 150, whereas in tax you will be allowed only 100. So you will record a DTL, deferred tax liability, of difference between 150 and 100. Okay, 50 into tax rate of 30%, which is 15. And the journal entry for this will be goodwill account debit 15 to DTL 15. So this is also an entry which will come whenever you do business combination, whenever the tax base, the carrying value as per tax which will be allowed for depreciation or deduction in future, okay, is different from the fair value. You don't have to compare PC and fair value. The difference between 180 and 150, you won't create deferred tax on this, but you will definitely create deferred tax on difference between 150 and 100. Okay, now let's go back to the PPT. So now we have done 4 steps: identify acquirer and acquisition date, identify and measure consideration transferred, identify and measure identifiable assets and liabilities, measure non-controlling interest. The last step is determine goodwill or gain on bargain purchase. Okay. Now, effectively in this example that we did, we have actually determined goodwill also. Right? Goodwill is always the balancing figure. Now, how is goodwill measured? I explained fair value of consideration paid, PC, plus fair value of NCI. If you take proportionate share of NCI, then proportionate share of NCI. So, fair value of PC plus NCI minus fair value of net assets acquired. Okay, that is going to give you goodwill. Okay. The third line here, fair value of previously held equity interest. This we will discuss separately, but as of now it is fair value of PC plus recognized amount of NCI that you compare with recognized amount of identifiable assets acquired. The difference is goodwill. Sometimes it may be negative goodwill also. In IFRS, negative goodwill goes to P&L. Under Ind AS, negative goodwill goes to capital reserve. Okay. The negative goodwill also called as bargain purchase. So it says if the fair value of net assets and NCI exceeds PC, then you recognize bargain purchase or negative goodwill or capital reserve. Okay, but only after reassessment of fair value. So you reassess the fair value, whether you have calculated it correctly, whether really you got a bargain deal out of this, only then you recognize capital reserve. Now, Ind AS also says that you take it through OCI, other comprehensive income. So how will it go to capital reserve? It can either go to capital reserve directly or it can go to capital reserve through OCI. So it says if, okay, I repeat, if the bargain deal, you have a reason, why did you get a bargain deal? Okay, the person wants to relocate, the person is in need of money, or there is some issues, the person is becoming bankrupt. If there's a reason why did you get a bargain deal, then the negative goodwill or the capital reserve is created through OCI. Okay. If there is no reason that you know of, why did you get a bargain deal? In that scenario, capital reserve is directly, or the negative goodwill is directly recorded in capital reserve. It will not go through OCI. Okay. Now this is only in case of normal, there's also a concept of business combination under common control that we'll discuss separately. I'll give you understanding of that at the end of this session, but everything that we are discussing is a normal business combination accounting. Okay. Now there are other issues around business combinations like intangibles, which I was talking about at the, when we were talking about what have you acquired, identifiable assets and liabilities. Okay. So there I was explaining that intangibles that you acquire, those intangibles like customer list or brands and trademarks, etc., those are recognized apart from goodwill, in addition to goodwill. Okay, or you separate it out from goodwill. Okay, it must be either resulting from contractual or legal rights, or it must be capable of being separated or divided from the acquired enterprise and sold, transferred, licensed, rented, or exchanged. Okay, examples that the standard gives is trademarks, customers, patented technologies. I also gave an example of unperformed contracts. Those are also recognized as intangible assets separately from goodwill. Say case study. Company A acquires Company B. Company B sells various brands of soaps and shampoos. However, since these brands are internally generated, it has not recognized them as intangible assets. When Company A acquires Company B, okay, it can recognize all those brands as intangible assets in the consolidated books. Let's take another example. A Limited acquired B Limited. The acquiree has service contracts to supply certain items to railways. Let's say dahi. Okay, Mother Dairy ka dahi. So A Limited acquires Mother Dairy. Mother Dairy already has a contract to supply dahi for railways. Okay. Should these service contracts be treated as service separate intangible asset? Yes. So if you have a contract for 5 years and 1 year has elapsed, 4 years remain. Okay. A Limited will recognize in its consolidated books the contract with railways for the balance 4 years as an intangible asset separately from goodwill. Let's take another case study. Equity M Limited has two distinct line of business: manufacturing of gearbox and manufacturing of headlights. It has supply contract with a passenger car manufacturer Y Limited to supply gearbox only. So Y Limited, it only supplies gearbox. Contract is there only for gearbox. There is no contract for headlights. However, Y Limited purchased headlights from M Limited as well. So you sold both headlights and gearbox, but the contract is only for gearbox. For headlight, there is no contract. However, the acquirer and the acquiree both believe that this relationship with Y Limited will continue for at least 5 years. That means you will keep supplying both headlight and gearbox for at least 5 years. Now, whether the acquirer can recognize both headlight and gearbox contracts with M. So contract is only of gearbox, not of headlight, but whether M Limited, for that, how will you measure the intangible asset? Whether you will recognize for both headlight and gearbox, or you will only recognize for gearbox. I'll give you 30 seconds to think about it, then I will give you an answer. Okay, so the answer is basically for gearbox, there is a contract. So it's a no-brainer. I just said that any contract which is there with the customer, you can definitely recognize it as intangible asset. However, for headlight also, since both acquirer and acquiree both have consensus on this matter that the relationship will continue for 5 years, that means Y Limited will keep acquiring gearbox also from M Limited. Sorry, headlights also from M Limited for next 5 years. So that is also a customer relationship which you will recognize as intangible asset, because that is what you will pay for also. So answer is for both you will recognize intangible asset. So for gearbox, supply contract for gearbox is contractual, for which acquirer should recognize. So this is a no-brainer. For headlight, sale of headlight is non-contractual, but it has a value, and as it is separable, the acquirer may recognize separate intangible asset and measure in terms of fair value. So answer is for both you will recognize a separate intangible asset. Okay, the next one is adjustments post business combinations. Now this is also very critical, because this is also something unique and different which is not there in accounting standards. Okay, if you have done business combination accounting, okay, uh, now what happens in business combination accounting, if you have done it, you would know that many a times when you acquire large companies, okay, it is spread out in multiple locations. It has multiple assets across multiple locations. Okay, say an Indian company also, if suppose it is present in 5 states or 7 states, okay, it will have multiple assets across state. Within a state also, multiple districts, it has multiple assets. And the standard requires you to fair value each of these assets and liabilities. Now suppose if the acquisition has happened closer to March, say January, Feb, or somewhere around that, you don't have time before the closing of the financial statements to fair value all these assets and liabilities. Correct? So how do I recognize in my financial statements? My financial statements need to be closed. I don't have time to fair value all these assets and liabilities before closing of the financial statements. What do I do? So standard allows 12 months from the date of acquisition. Okay, so in suppose if the acquisition has happened in say February 2022, Feb 2022 you have acquired a business which has such spread out assets and liabilities. I don't have time to do fair valuation before March 22 accounts are closed. So in March 22 financials, I will take an estimate or provisional numbers and I will disclose that all the fair value that I have considered for business combination accounting is provisional in nature. Based on provisional fair valuation, I will do the accounting, calculate goodwill, recognize it, disclosures, everything I will do based on provisional numbers. Okay, then the standard allows me 12 months from the acquisition date. So from Feb 22 till say Feb 23, I have time to actually do fair valuation and all of that stuff. That I can, when I do that, suppose I do that in August 22. Okay, I have all the fair values by the time August 22 arrives. Then I can account all these assets at fair value as if the accounting happened in Feb. So that means 4-5 months depreciation and all that you will provide, and do all the adjustments in goodwill. So my goodwill which I calculated was provisional, it was not final. In August 22 I finalized the goodwill. In March 23 when I present the accounts, I will disclose that this was the provisional numbers which I presented in March 22. These are the final numbers which I am presenting now. So final goodwill is this. Okay, so the standard allows me 12 months to finalize my business combination accounting. Okay, so if any new information is obtained about facts and circumstances that existed as of acquisition date, you can do all those adjustments post business combination accounting also, but it cannot exceed 1 year. Okay, now see, this is not for errors. Okay, if there is a prior period error, then you follow Ind AS 8, you go back and adjust all the prior periods. Okay, this is only if your information is not available because you have to close your balance sheet or finalize your accounts. Okay, information is not available and you clearly mention that the accounting has been done on provisional basis. If you don't mention that accounting has been done on provisional basis, then you are not allowed to do retrospective adjustment. Then everything else afterwards will either be an error or it will go through P&L. You are not allowed to adjust goodwill after that. You are allowed this window of 12 months only if you clearly mention in your notes that the numbers that I am presenting in accounts are on provisional basis and I will finalize within next 12 months the final numbers. You have to make that disclosure. If you make that disclosure, the 12-month window is available to you. If you don't make that disclosure, then the window is closed and only error window is open for you, or you take every other adjustment from P&L, income statement. So say example, entity A and entity B. Entity A acquires entity B on 1st of Jan 2011. Entity A seeks an independent valuation for property, plant and equipment acquired. Valuation was not completed by the time you finalized your financial statements. So you have considered provisional fair valuation. In July, the fair valuation final was obtained. So you adjust retrospectively the goodwill and all the assets and liabilities, everything you adjust retrospectively. If any information is received after 12 months, then you are not allowed to retrospectively adjust the goodwill. Every other adjustment will be taken care in your P&L or income statement. Okay. Now, the next concept is on step acquisition. Step acquisition is again a very critical matter and an important important concept. Okay. Now imagine that you have 15% shares in the acquiry on day one. When you have 15% shares, it's a simple investment like any other normal investment that you have. You may call it strategic investment, but it's a normal investment. The investee does not become your associate or joint venture or subsidiary in normal scenarios. Okay. And then you acquire 60% more. So it goes to 75%. That is step acquisition. Another example is 15 to 35, 35 to 75. So from 15 to 35 it becomes your associate or joint venture, and 35 to 75 it becomes your subsidiary. When you move from 15 to 75 or 15 to 35 to 75 or 35 to 75, all these movements are called as step acquisition. Okay. Anything that you move, say once you have come to 75, anything from 75 to 80 or 75 to 70 or 75 to 60 or 75 to 90, all these changes are not considered as business combination. Okay. So with 75 to 90, 75 to 60, you already had control, you still have control, you will continue to have control. Correct? At 75 also you have control, at 90 also you have control, at 60 also you have control. So 60 to 75 to 90, all these changes are not considered as business combination. And since these are not considered as business combination, you are not allowed to adjust the goodwill. Your goodwill remains constant. Okay. All the adjustments will happen in reserves and surplus. You will not take it to P&L. You will not adjust your reserves. You will not adjust your goodwill. You will not take it to P&L. Everything remains in reserves. Any profit or loss you do by buying 75 to 90 or selling 75 to 60, all that profit or loss will sit in reserves. Okay. Only when you move from 50 to 75, that is non-controlling to control, or 35 to 75, non-controlling to control, or 75 to 25, controlling to non-control, then changes happen, then goodwill changes, then business combination accounting happens, all that stuff. Okay. Now how do you take care of business combination in these circumstances when you move, say example 15 to 75? Simple. Okay. Don't worry, very, very simple. When you are at 15, you are accounting for these investments at fair value, either fair value through P&L or fair value through OCI. Normally this being strategic investments, you would value at fair value through OCI. Okay. When you move from 15 to 75, you have bought 60% more. What happens? Let's go back to Excel and check what happens. Okay. So 15%, I am doing fair valuation accounting. The fair value is 100. I bought 60% more. This I have bought at say 500. Now what do I need for doing business combination? I need PC. I need fair valuation of net assets, and then I calculate NCI. These are the only three things required. Okay. Balancing figure is goodwill. So I calculate goodwill. So if I have PC and fair value of net assets, my business combination accounting can be done, because remaining two I am just calculating. Correct? Now fair value of net assets, I need to appoint someone to do fair valuation. So what I need is only PC. Okay. How do I get PC? Simple. It says you fair value this 15%. You take the cost of this 500 per this 60%. So your PC is 600. Simple. Nothing else to be done. So you have PC. You have determined the fair value of net assets, and you can do your business combination accounting. Similarly, suppose I move from 35 to 6 to 75. So I buy 40% more. So when I had 35%, okay, I was doing accounting as equity method in my consolidated financial statements. Equity method, suppose the value was again 100. Okay, now the first step I have to do here is I have to fair value them. Fair value suppose comes to 120. For 40% purchased, this is at 500 suppose. Okay, so PC becomes 500 plus 120. So PC is 620. What happens to difference of this 20? Difference of this 20 is recognized in P&L. So this 20 will go to P&L. I have fair value of 120, purchase at 500, cost is 500. So 120 plus 500, 620. 620 becomes my PC. Fair value of net assets I can anyways do, and then I can do my business combination accounting. So that's simple, right? So this is how step acquisition works. So remeasure previously acquired non-controlling interest at fair value, and then adjustment in P&L unless carried at FVOCI. In case it is at FVOCI, then any change in fair value remains in reserves. You cannot take it to P&L. And goodwill from all previous acquisitions is ignored. You recalculate goodwill whenever you have business combination scenario. So this is, you know, if I go back, see here the third point, fair value of any previously held equity interest in the acquiree. This is nothing but step acquisition, which we just discussed. So this third point I had left earlier. This is step acquisition, which we discussed now. So basically goodwill is fair value of consideration transferred, which is the cost of 40% that you acquired now, plus NCI, plus previously held, you already held 35%. So 35% at fair value, 40% at cost right now, whatever you have paid. Okay, and then what is the NCI? When you add all these three, this becomes your PC plus NCI, and then you subtract fair value of net assets and you get goodwill. This is the formula for goodwill. So last concept that I wanted to discuss was business combination in common control. Okay, under IFRS, common control business combination is excluded from the scope of IFRS 3. Excluded means it does not prohibit, but it says Ind AS 103 is not applicable to common control business combination. If Ind AS 103 is not applicable, what accounting to be done? You do whatever accounting you want to do. Standards don't give guidance. IFRS standards don't give guidance on common control business combination. So people do different kind of accounting. Some do carrying values, some do fair values. So different people do different accounting. Okay. Under IFRS now, IASB is coming out with some guidance. It might take 6 months, 1 year, but they are trying to come out with some guidance for common control business combinations. Okay. Under Ind AS, we are ahead of IFRS. Under Ind AS 103, there is Appendix C. Appendix C to Ind AS 103, it talks about common control business combinations. Okay. Now, this appendix says that in under common control business combination. But what is common control business combination? I have been talking about common control since last 2 minutes. What is common control? Again, go back to Excel. Suppose this is A. A has a subsidiary B and subsidiary C. Okay, so this is parent. This is subsidiary. Okay, parent plus subsidiary is called as a group. Group is equal to P plus S. Parent plus subsidiary is a group. Okay, now when I say subsidiary also means B has a indirect subsidiary, or say subsidiary, indirect subsidiary or subsidiary. So B has a subsidiary D, and suppose D and E, and C has a subsidiary F. Okay, so this A, B, C, D, E, F, okay, all these together becomes a group. Okay, this group is all a group. Okay, this is called common control. A group is a group of entities having common control. Okay, common control is with A. Now any business combination within this group, that means D merges with A, D merges with B, D merges with E, F merges with C, F merges with E, F merges with B, F merges with A, F with C, E with C, any combination that you can think of within A, B, C, D, E, F, okay, is called as a common control business combination. Okay. In common control business combination, because A is preparing a consolidated financial statements, and the consolidated financial statements of A does not change. Why will it change? Because of something happening within A. It's called restructuring, right? Anything which is happening within this group A is nothing but a restructuring. So because of restructuring, consolidated financials of A should not change. Okay. So Appendix C of Ind AS gives guidance on common control business combination. It says that in common control business combination, you should apply, if you know of pooling of interest method under AS14. Okay, similar method it asks to apply. Ind AS 103 says you have to apply similar method as pooling of interest method. What happens in pooling of interest method? All assets, liabilities and reserves at carrying value. Okay, difference between purchase consideration and net assets, let me call this as net assets. Difference between purchase and consideration and net assets is adjusted in reserves. So you don't have goodwill. Okay, when you adjust it in reserves, basically you are creating a capital reserve. This capital reserve can be positive or negative. It can be positive or negative. Either ways it will be capital reserve. So whether it is negative or it is positive, you have to create a capital reserve and you have to post it in capital reserve only. Positive, negative does not matter. Even if a reserve is negative, you have to keep it as negative. Okay, you don't take it to asset. So capital reserve will be created whether positive or negative. So simple accounting is there. You do pooling of interest method wherein you take all assets, liabilities and reserves at net assets, which is called as net assets at carrying value. Difference between the purchase consideration and net assets will be called as capital reserve. Okay, and this capital reserve will be either positive or negative depending upon whatever is the value and what you have paid. So this is called as common control business combination. Now common control business combination presentation, and this is very critical. Okay, presentation. Now normally acquisition date, we spend a lot of time on acquisition date in a business combination. In a common control business combination, acquisition date is equal to earliest period presented opening balance. What does this mean? Okay, so basically suppose this ABCD, this group is existing since 2015. Okay, and now what is happening is D is merging with C in 2022. Now in 2022 you present 2022, you present previous period 2021. So you have to assume that the merger happened in 2015 itself. Present the impact of business combination in April 1, 2021, which is the opening of the earliest period presented. Okay, so what would have been the impact had the merger happened in 2015 itself, when the group was formed in this form? Okay, so assume that merger happened in 2015 itself, present the impact of business combination from 1st of April 2021, and then 2022 and 2021 will be prepared will be, I should say, adjusted as if the merger was always existing. This is the most critical point in common control business combination. Common control business combination will not work from the effective date of a scheme. It will not work from the appointed date of the scheme. It will work in this fashion only. So when you mention the accounting in the scheme, ensure that you mention as per Appendix C of Ind AS 103 only. Okay, the accounting will be as given in Appendix C of Ind AS 103, or you bring out the excerpts out of Ind AS 103 and mention in the scheme. Only then the scheme is compliant with Ind AS. Okay, you cannot do merger from the appointed date or effective date. You have to assume that the merger has happened from the date when it first became the subsidiary, which is 2015 in our example. Okay, so this is how business combination works, or common control business combination works. So we have discussed in quite detail how things will work. I would now welcome questions, if any, on any of these topics that we discussed. Vaibhav or the team, can you help with questions if there are any? Just 1 second. I'll call up Vaibhav and check if there are questions, and we can then I can then take up the questions and answer all of them. Yeah, so just a minute. I'll take up the questions. The questions will be posted, so I'll just take up the questions.
क्या क्वेश्चन दे रहा हूँ सर?
हाँ, प्लीज बताइए. Request to explain example of contingent consideration. Sure, I'll take up contingent consideration again. So basically, what I had explained in contingent consideration. Firstly, if any consideration is contingent upon a future event. Okay, what is a future event? We discussed that if there is uh, suppose initial consideration is 100 rupees, then 20 rupees more if profit is X, 10 rupees furthermore if profit after 2 years is X plus 2. Okay, so your consideration goes up if there is a profit after 1 year, or there is X profit after 2 years. So it is contingent upon future profits, correct, or future revenues or future share price. These are examples of how contingent consideration works. Okay, so because this is contingent upon future achieving of profits or share price, these are called as contingent consideration. Now, how do you account for contingent consideration? First, you check what is the probability of after 1 year share price being what you have mentioned as a uh, condition, or profit. What is the chances of profit being what you have mentioned as a condition? Suppose the probability is 70% that you will achieve those profits or share price, and you will pay 20 rupees extra if those profits are achieved. So probability multiplied by 70%, 70% is the probability, multiplied by 20 rupees that you will pay extra if it is achieved. So 14 rupees, and then you discount it by 1 year or 2 year basis when you will pay this amount. So suppose discounting element is 1 rupee, So 13 rupees is the fair value of the contingent consideration. So my total purchase consideration is 100 rupees which I pay upfront plus 13 rupees which is fair value of contingent consideration. So 113 is the total purchase consideration which I will use for calculating goodwill. Okay, so these are the normal examples of contingent consideration. This is come in Ind AS 103, but this was always present in US GAAP. US GAAP was always using such concepts of contingent consideration. Ind AS is new for us, so hence these concepts probably we are learning right now. But these exist in normal world, in normal business combinations which you do. Such type of conditions are always there. That depending upon future profits, you give more money. Okay. Then second question is, what will happen if fair value is less than the carrying value? Whether deferred tax will be created? Yes. Yes, sir. If fair value is less than carrying value, then also deferred tax will be created, but that will be deferred tax asset. Okay. So what will happen is you will create deferred tax assets in that cases. Can I share my screen? Just 1 second. I'll share my screen for 1 second, and then we can again go back to. Can you allow me to share my screen once? Thank you. So we were doing for deferred tax. 1 second. Which one was? Just 1 second. No? Where was the deferred tax? Yes, here. Okay. So this was the example we were looking at for deferred tax. Now let me copy this example. Okay, here. Now the question which you are asking is, what if instead of 150 this was 80? Okay, and let the PC be what it is. In that case, this will be deferred tax asset DTA of 20. Okay, 20 is the difference, 80 minus 100. So on that you will create a deferred tax asset of 6. So your entry will be goodwill debit. So here what will happen is DTA debit to goodwill. So goodwill will go down by 6 and deferred tax asset will be created of 6. So this will be the accounting if fair value is lower than carrying value, but deferred tax will be created for sure. Okay. Thank you. Can you display the question again? The last one. There was 3 questions, I think. Thank you. So third one is A Limited is holding company having B, C and D as its subsidiary. Now D is going to acquire A. Then how the acquisition will take place? Excellent question. So first of all, if A is holding company of A, B, C, and D, that means this is a group of parent and subsidiary. If this is a group of parent and subsidiary, then if D acquires A or D merges with A, in either ways, this will be a common control business combination. Okay. Now, if D is going to acquire A, then what will happen to B and C? So D will get shares of B and C which A had. So D will become parent of B and C. Okay. First, this will happen. Secondly, D will do consolidation of B and C, and A is already merged with A. A is already merged with D. So D merged will prepare a consolidated financial statements of D, B, and C. Now, because this is a common control business combination, whatever was A consolidated, only the name is changing to deconsolidated. Okay. Otherwise, as a group, consolidated A consisted of A, B, C, D. Similarly, consolidated D will consist of A, B, C, D in substance. A is not there in form, but in substance, A, B, C, D remains A, B, C, D. Correct? Because you have not brought in a third external party. You have not sold to a third external party. You have not purchased from a third external party. It's like from one pocket to another. भाई भाई में जो भी करो वो तो रहेगा घर में ही. Correct? So ABCD will always remain ABCD. So consolidated A, only name will change to consolidated D. Otherwise, the consolidated financial statements will remain same. That is how you have to see it, and that is how you will have to account for it. Only thing which will change is the constituents of your equity, total equity, which we call it, which is equity shares plus reserves and surplus, because now equity share capital and securities premium will be that of legal entity D. Reserves and surplus, you might create some capital reserve and all that stuff basis, what is how the accounting happens. There will be some capital reserve that you will create. So the constituents of reserves will change, but the total equity, total shareholders funds, if I can call it, will remain same at the consolidated level, whether it was A consolidated or whether it is deconsolidated. Effectively, the net assets will remain same, in short. Okay, only equity share capital, securities premium, other reserves, that constituents ka value will change, but total value will remain same. I hope I am being clear here. Okay. That's it. Any other questions? If there's no other question, then that's all I have. There's nothing else. Yes. So that's it. Can we end the session?
Hello, Abhishek sir. Hello.
Hello.
Yes, sir. Can you hear me?
Yes, sir.
Yeah. Okay. Thanks a lot, CA Anand Banka, sir. It was amazing. On behalf of all the participants, I would like to give you, CA Anand Banka, sir, a huge round of applause. It was really an intriguing session wherein you covered all the minute details concerning today's topic, which was business combination, preparing Ind AS financials, Ind AS adjustments, disclosures. Definitely, we are better equipped now after this session. You also took up case studies which helped us understand the concepts in a better fashion, also answering our doubts and queries patiently. I'm sure had we met on a physical forum, the participants would have definitely given you a standing ovation.
Oh,
Nonetheless, once again, offer you sincere gratitude on behalf of all the participants. Thanks a lot, sir. Thanks a lot for your thoughts and inputs.
Pleasure. Thank you so much. Thank you.
Yeah. Participants, we end the session here, and tomorrow being a Sunday, we are not going to meet, so it's a holiday, and we gather again on Monday at 4 o'clock in the evening. Thank you. Thanks a lot.
Thank you.